Welcome back to our channel. Today, we'll dive into the fascinating world of investing with one of the greatest investors of all time, Warren Buffett. Let's explore the 12 mistakes many investors make throughout their financial journeys and learn from Buffett's accumulated wisdom over decades of success in the financial markets. Mistake 1: not having a strategy. Starting the investment journey without a solid strategy is like navigating an ocean without a map. Warren Buffett highlights the fundamental importance of having a clear strategy when investing, and here are some key points to consider. Define your financial goals. Before investing, it is crucial to clearly define your financial goals. Are you saving for retirement, to buy a house, or for your children's education? Set specific, realistic financial goals. Assess your risk profile. Each investor has a different risk profile. Some people may be willing to take high risks in pursuit of higher returns, while others prefer more conservative investments. Assess your own level of risk tolerance. Determine a time horizon. Your investment strategy should take into account the time horizon. If you're investing for long-term goals, such as retirement, it may be more appropriate to adopt a long-term investment strategy. Choose appropriate asset classes. Warren Buffett always emphasizes the importance of choosing assets you understand. Decide whether you want to invest in stocks, bonds, real estate, or a combination of them, based on your understanding and goals. Diversification. An essential part of any investment strategy is diversification. Don't put all your eggs in one basket. Distributing your money across different assets helps reduce risk. Regular rebalancing. A strategy is not something static. It's important to monitor and adjust your portfolio periodically to ensure it's aligned with your goals and risk tolerance. Maintain discipline. Once you have established your strategy, maintain discipline. Avoid making emotional decisions based on short-term fluctuations in the market. In short, the number one mistake that Warren Buffett warns us about is not having a clear and well-defined investment strategy. Having a solid strategy not only helps guide your investment decisions, but it also helps protect your equity over time. So before you start investing, take the time to devise a strategy that fits your goals, risk profile, and time horizon. This will be the foundation for a more solid and successful investment journey. Mistake 2: follow crowds. The mistake of blindly following the crowds is one of the most common mistakes investors make. Often, investors are influenced by popular opinion and market trends, which can lead to risky and sometimes damaging financial decisions. Here are some important questions to consider. Herd of investors. When many people follow the same strategy or invest in a specific asset because everyone is doing the same, this is known as an investor herd. This herd mentality can lead to asset bubbles, where prices are artificially inflated and eventually can collapse. Contrarian thinking. Warren Buffett is known to be a contrarian thinker. He often invests at times when others are afraid, and avoids investing when the market is in euphoria. This contrarian approach can help you avoid following the crowds. Independent research. Instead of relying on popular opinion or investment tips, Warren Buffett advises investors to conduct their own independent research. This means analyzing financial data, understanding a company's business model, and assessing its growth potential. Investing with conviction. When you follow the crowds, you may be tempted to move in and out of the market frequently, based on short-term fluctuations. Buffett emphasizes the importance of investing with conviction and holding long-term positions. Emotional control. Following crowds is often linked to emotional decisions. It is important to maintain emotional control when investing, not getting carried away by the panic or greed of the market. Remember the fundamentals. Instead of just following the herd, focus on the fundamentals of the companies you invest in. Assess whether they have solid business models and healthy financial fundamentals. In conclusion, following the crowds can be a harmful mistake when investing, as it often leads to decisions based on emotions rather than careful analysis. Warren Buffett teaches us that it's essential to be a contrarian investor, do independent research, and maintain emotional control. Remember that investment success is often associated with the ability to make rational, informed decisions rather than following the popular opinion of the moment. Therefore, when investing, stay true to your strategy and don't blindly follow the crowds. Mistake 3. Lack of research. Lack of research is a crucial mistake that can have serious consequences on investments. Warren Buffett is known for devoting considerable time to research before making important financial decisions. Let's take a deeper look at this mistake and how to avoid it. Understand the company. Before investing in a company, it is essential to deeply understand its business model, industry, competition, and its growth prospects. Lack of research can lead to investments in unknown or poorly managed companies. Financial data analysis. Research involves the thorough analysis of a company's financial data. This includes the evaluation of annual reports, balance sheets, income statements, and cash flows. Buffett is known for his ability to crunch numbers to determine a company's intrinsic value. Company management. Knowing the management team is crucial. Research the background of the company's key executives and assess their competence and integrity. Warren Buffett often invests in companies with solid and reliable management teams. Competitiveness. It is important to understand how the company positions itself in relation to the competition. Buffett values companies with enduring competitive advantages, such as strong brands, economies of scale, or ownership of unique resources. Risk assessment. Research also involves identifying and evaluating the risks associated with an investment. This includes company-specific risks as well as macroeconomic risks that may affect its performance. Dividend history. For investors interested in income, analyzing a company's dividend payment history is important. Buffett values companies that have a consistent track record of paying growing dividends. Constant update. The research does not end after the initial investment. It is important to continue to monitor the company's performance and make adjustments to the portfolio if necessary. In short, a lack of research is a mistake that can result in hasty and risky investment decisions. Warren Buffett teaches us that careful and diligent research is key to making informed and successful decisions in the investment world. Therefore, before investing in any asset, take the time to fully research and understand the company or asset in question. Solid research is a powerful tool to help protect your wealth and achieve your financial goals. Mistake 4. Impatience. Impatience is a mistake that can significantly hurt investors, often leading to impulsive and sometimes damaging financial decisions. Warren Buffett emphasizes the importance of staying calm and taking a long-term perspective when investing. Let's take a closer look at this error and how to avoid it. Long-term vision. One of Warren Buffett's most valuable lessons is the importance of maintaining a long-term vision. Successful investments often take time to mature and grow. Impatience can lead investors to sell assets prematurely, missing out on the potential for long-term appreciation. Avoid spinning behavior. Impatience can lead to what's known as spinning or overtrading. This involves the frequent buying and selling of assets, often in response to short-term movements in the market. Turnover can increase costs and taxes, hurting returns. Reacting to short-term news. Impatient investors often overreact to short-term news and events, such as quarterly earnings reports or sensationalist headlines. Buffett advises staying calm and considering the big picture before making decisions based on isolated events. Harnessing the composition of interest. Patience is key to harnessing the power of interest composition over time. Letting your investments grow and reinvesting dividends or earnings can result in a significant increase in the value of your portfolio over the years. Avoiding market guesswork. Trying to predict short-term market movements is a risky endeavor. Impatience often leads investors to make wrong predictions and make hasty decisions based on short-term expectations. Keep a plan. Buffett emphasizes the importance of maintaining a consistent investment plan and sticking to it, even when the market experiences volatility. Having a solid plan helps you resist the temptation to act impulsively. In short, impatience can be an enemy of investors, leading to hasty financial decisions that can hurt their long-term returns. Warren Buffett teaches us that patience is a virtue in the investment world. By maintaining a long-term view, avoiding spinning behavior, and resisting the temptation to react to short-term events, investors are more likely to achieve financial success over time. So remember that investing is a marathon, not a race, and impatience can be detrimental to your portfolio. Mistake 5. Lack of diversification. Lack of diversification is a common mistake that occurs when investors put a significant portion of their resources into a single asset class, or sector. Warren Buffett emphasizes the importance of diversification as a strategy for managing risk and improving portfolio resilience. Let's take a closer look at this error and how to avoid it. Concentrated risk. When you don't diversify, your risk focuses on a single investment or a few investments. If the performance of an asset or sector is negatively impacted, this can have a significant detrimental effect on your portfolio. Sectors and asset classes. Diversification involves distributing your investments across different sectors of the economy and asset classes such as stocks, bonds, real estate, and others. Diversifying across different industries helps reduce the negative impact of poor performance in a specific industry. Geographic diversification. In addition to diversification by industry, consider geographic diversification. Investing only in your geographic region can expose your portfolio to risks specific to that market. Consider international allocation to spread the risk. Risk reduction. Diversification is a strategy that aims to reduce risk. While it won't completely eliminate risk, it can help protect your portfolio from excessive losses in any particular area. Rebalancing. When you diversify your portfolio, it's important to rebalance regularly. This involves adjusting allocations according to your goals and risk tolerance. For example, if an asset class appreciates substantially, it may be necessary to sell part of it and reallocate resources to underrepresented areas. Performance tracking. When diversifying, it's critical to track the performance of each component of your portfolio. This will help you make informed decisions about when to make adjustments. In summary, a lack of diversification is a mistake that can result in significant exposure to specific risks and undermine the resilience of your investment portfolio. Warren Buffett advises investors to diversify to reduce global risk and protect their assets. Remember that diversification not only helps manage risk, but can also potentially improve returns over time as you are positioned to benefit from different investment opportunities. Therefore, when planning your investment strategy, consider diversification as a key tool for long-term financial success. Mistake 6. Not controlling emotions. Not controlling emotions is a common mistake that can lead to impulsive and damaging financial decisions. Warren Buffett emphasizes the importance of staying calm and acting on rational principles rather than emotional reactions. Let's dig deeper into this mistake and understand how to avoid it. Fear and greed. Two predominant feelings that can affect investors are fear and greed. Fear can lead to hasty selling decisions in times of market downturn, while greed can encourage the purchase of overvalued assets. Buffett advises not to get carried away by these emotions. Patience in times of crisis. In times of market turmoil, such as recessions or corrections, it is crucial to maintain patience and not make impulsive decisions. Many investors sell their assets for fear of additional losses, but Buffett points out that often the biggest buying opportunities come when the market is down. Herd behavior. Fear and greed are often exacerbated by herd behavior. When everyone is acting similarly, it's easy to get carried away by the group's emotion. Buffett emphasizes the importance of resisting crowd pressure and acting according to your own strategy. Long-term focus. One of Buffett's key teachings is to stay focused on the long term and not be shaken by short-term fluctuations. Volatility is a natural part of the market, but successful investors maintain a long-term view. Discipline and planning. Having discipline in your investment approach is key. This includes sticking to your investment plan, staying calm during market ups and downs, and avoiding emotional decisions that could hurt your financial goals. Financial education. An effective way to combat impulsive emotions is to invest in financial education. The more you understand the principles of investing and the financial fundamentals, the more confident and prepared you will be to make rational decisions. In short, not controlling emotions is a mistake that can significantly hurt investment performance. Warren Buffett teaches us that success in investing requires self-control and emotional discipline. Avoiding impulsive reactions, staying focused on the long term, and resisting herd behavior are all key elements to achieving your financial goals. Therefore, when investing, remember that emotions can be your biggest enemy, and it is essential to remain calm and rational in all financial decisions. Mistake 7. Ignoring the fundamentals. Ignoring the fundamentals is a mistake that occurs when investors do not conduct a proper analysis of the companies or assets in which they are investing. Warren Buffett is known for his emphasis on solid fundamentals and careful evaluation of companies before making investments. Let's take a closer look at this error and how to avoid it. Intrinsic value valuation. Warren Buffett is an ardent proponent of valuing a company's intrinsic value. This involves calculating the actual value of the company based on its financial fundamentals, such as profits, cash flow, assets, and liabilities. Financial analysis. Ignoring the fundamentals often results in not analyzing the company's financial data in detail. This includes reviewing financial statements, balance sheets, and income statements to understand your financial health. Business model. Understanding the company's business model is crucial. What is your source of revenue? How does she make money? What are your competitors? Buffett advises investing only in companies whose business models you understand. Competitive advantage. Identifying companies with lasting competitive advantages is a key part of Buffett's analysis. It looks for companies that have significant barriers to entry, such as strong brands, economies of scale, or patents. Competent management. Ignoring the fundamentals also includes not assessing the competence of the management team. A competent management team is essential to a company's long-term success. Understand the industry. It is important to understand the industry in which the company operates, including its trends, regulations, and factors that may affect its performance. Potential risks. Ignoring the fundamentals often leads to neglecting the risks associated with an investment. It is important to identify and assess company and industry-specific risks. In conclusion, ignoring the fundamentals is a mistake that can result in hasty and risky investment decisions. Warren Buffett teaches us that careful analysis of the fundamentals is essential to making informed financial decisions. Before investing in any asset, take the time to fully research and understand the company, its financial fundamentals, its business model, and its growth potential. By doing so, you'll be in a much better position to make sound investment decisions that align with your financial goals. Mistake 8. Market timing. Market timing is a common mistake that occurs when investors try to predict short-term financial market movements, such as the optimal time to buy or sell assets. Warren Buffett is known to advise against this practice and emphasize the difficulty of accurately predicting market behavior. Let's take a deeper look at this mistake and how to avoid it. Impossibility of prediction. The financial market is notoriously difficult to predict in the short term. Trying to guess when the market will reach its peak or bottom is an extremely risky task. Buffett often compares trying to time the market to betting on a horse race. Loss of opportunities. Trying to time the market often results in the loss of investment opportunities. You can expect to buy stocks at an ideal time, but in the meantime, the market may rise and you miss out on potential gains. Stress and anxiety. Market timing can cause significant stress and anxiety. Investors who are constantly trying to predict market movements can suffer from constant emotional pressure. Fees and taxes. Buying and selling assets frequently can result in high costs such as brokerage fees and capital gains taxes. This can significantly reduce your net returns. Long-term focus. Warren Buffett advises investors to stay focused on the long term and to invest based on solid fundamentals rather than trying to time the market. He emphasizes that time in the market is more important than trying to time the market. Consistent investing. A more solid strategy is to invest consistently over time, regardless of short-term fluctuations. This is known as dollar-cost averaging, and it's an approach that minimizes the risk of entering the market at the wrong time. Maintain a strategy. Having a clear investment plan and following it is key. Avoid making emotional decisions based on market volatility. In short, market timing is a mistake that can hurt your returns and increase investment-related anxiety. Warren Buffett teaches us that focusing on the long term, investing consistently, and avoiding the temptation to try to predict the market are key elements to investing success. Instead of worrying about timing the market, focus on building a solid investment portfolio based on solid fundamentals and maintain discipline over time. Remember that the market is unpredictable, but a well-planned investment strategy can help you achieve your financial goals. Mistake 9. Focus on the short term. Short-term focus is a common mistake that occurs when investors focus excessively on short-term results and lose sight of the big picture. Warren Buffett is known for his long-term approach and believes that success in investing is about patience and forward thinking. Let's take a deeper look at this mistake and how to avoid it. Impatience. Focus on the short term often leads to impatience. Investors can become anxious and make hasty decisions in response to short-term fluctuations in the market. Volatility. The financial market is naturally volatile in the short term. Stock prices can rise and fall rapidly, often due to unpredictable events. Trying to keep up with all of these swings can be stressful and counterproductive. Excessive active management. Focusing on the short term often leads to excessive portfolio management, which involves the frequent buying and selling of assets. This can result in high costs and negatively impact returns. Long-term opportunity loss. Success in long-term investments usually involves holding positions for an extended period to allow investments to grow and harness the power of interest composition. Emotional decisions. When investors focus on the short term, they are more likely to make emotional decisions based on fear, greed, or news of the moment. Inability to withstand volatility. The focus on the short term often leads investors to sell their shares during downturns, when in reality, this may be a buying opportunity. Patience and discipline. Warren Buffett emphasizes the importance of patience and discipline when investing. He believes that true investment success manifests itself over many years, not in a matter of days, weeks, or months. In short, focusing on the short term is a mistake that can hurt investment performance and increase investment-related anxiety. Warren Buffett teaches us that success in investing is often about long-term focus, patience, and discipline. Instead of trying to keep up with market volatility on a day-to-day basis, consider taking a long-term investment approach, maintaining solid, diversified positions based on solid fundamentals. Remember that true growth potential usually manifests itself over many years, not in short-term movements. Mistake 10. Not learning from mistakes. Not learning from mistakes is a mistake that occurs when investors make mistakes in the financial market but fail to draw valuable lessons from those experiences. Warren Buffett emphasizes the importance of learning from mistakes to improve financial decision-making. Let's take a deeper look at this mistake and how to avoid it. Repeat mistakes. If investors don't learn from their past mistakes, they are likely to repeat them. This can result in ongoing financial losses and frustration. Post-failure analysis. Buffett advises conducting a careful analysis after an unsuccessful investment, This involves examining what went wrong, what factors contributed to the failure, and how to avoid making the same mistake in the future. Strategy adaptation. Learning from mistakes allows investors to adapt their strategy and make more informed decisions in the future. This may include adjustments to asset allocation, investment selection, or risk management. Emotional control. Financial mistakes are often related to hasty emotional decisions. By learning from these mistakes, investors can strengthen their emotional control and avoid impulsive reactions in the future. Continuous improvement. Warren Buffett is an advocate of continuous improvement. He emphasizes that even experienced investors can hone their skills and knowledge constantly. Financial education. Learning from mistakes is an important part of financial education. The more you understand your own decisions and the results of them, the more able you will be to make informed decisions in the future. Don't blame yourself. It's important to remember that all investors make mistakes at some point. The key is not to blame yourself, but rather to learn and improve. In short, not learning from mistakes is a mistake in itself. Warren Buffett teaches us that true success in investing is related to the ability to learn from past experiences and apply that knowledge to improve future decisions. Instead of being discouraged by financial mistakes, see them as opportunities for growth and improvement. Perform post-failure analysis, adapt your strategy, and continue to seek knowledge to become a wiser and more experienced investor. Remember that mistakes are part of the learning process and can help build a more solid path to financial success. Mistake 11. Overspending on fees. Overspending on fees is a mistake that occurs when investors don't pay attention to the costs associated with their investment decisions. Warren Buffett is known to be an advocate of minimizing costs when investing, as they can significantly hurt long-term returns. Let's take a deeper look at this mistake and how to avoid it. Management fees and commissions. Many investments, such as mutual funds and ETFs, charge management fees and commissions. These fees can vary considerably and, over time, can significantly erode earnings. Impact on profitability. Investment fees have a direct impact on net profitability. The higher the rates, the lower the return investors get. Hidden fees. In addition to management fees, it is important to be aware of hidden fees such as redemption fees, transaction fees, and capital gains taxes. Cost comparison. Warren Buffett advises investors to compare the costs of different investment options before making a decision. Choosing investments with lower costs can significantly increase returns over time. Time impact. Rates have a cumulative impact over time. Investing in options with lower fees allows your money to grow faster over the years. Long-term investing. Minimizing costs is especially important for long-term investors, such as those who are saving for retirement. High rates can significantly impair the accumulation of wealth over decades. Low-cost diversification. One way to avoid overspending on fees is to invest in low-cost options, such as low-cost index funds, that offer diversification at affordable prices. In short, overspending on fees is a mistake that can seriously hurt investment returns over time. Warren Buffett emphasizes the importance of minimizing costs when investing to maximize the growth potential of your wealth. Before choosing any investment, carefully examine the fees associated with it and consider low-cost options that can help preserve your equity and improve your long-term profitability. Remember that every penny saved in fees is a penny more that can be invested for your financial future. Mistake 12. Lack of discipline. Lack of discipline is a mistake that occurs when investors fail to maintain a consistent investment strategy and deviate from their financial plans. Warren Buffett emphasizes that discipline is key to success in investing. Let's take a deeper look at this mistake and how to avoid it. Deviation from the plan. Lack of discipline often leads investors to deviate from their financial plans. This can include buying and selling assets impulsively or overreacting to short-term events in the market. Impact on emotional decisions. when investors are not disciplined, they are more likely to make emotional decisions rather than rational ones. This can hurt the profitability of the portfolio. Maintaining a plan, having a clear investment plan and adhering to it is key. Discipline involves resisting the temptation to make hasty decisions based on market fluctuations. Avoid herd behavior. Discipline helps prevent herd behavior, in which investors follow the crowd instead of making independent, informed decisions. Patience in times of crisis. Discipline is also crucial in times of crisis. Many investors panic and sell their assets during market downturns, instead of remaining disciplined and maintaining a long-term view. Monitoring and rebalancing. A disciplined approach involves constantly monitoring the portfolio and regularly rebalancing to ensure it is aligned with your financial goals. Self-control. Discipline requires self-control. This means resisting the temptation to spend money on impulsive purchases or to make emotional investments. In short, a lack of discipline is a mistake that can seriously hurt investment performance and lead to damaging financial decisions. Warren Buffett teaches us that discipline is crucial to achieving financial success. Maintaining a consistent investment plan, resisting market emotions, and staying true to your financial goals are key elements to avoiding investment mistakes. Therefore, when investing, remember that discipline is a valuable ally that can help protect and grow your wealth over time. Overall conclusion. And there you have it, the 12 mistakes Warren Buffett warns us to avoid in our investment journey. Remember that, just like Buffett, you can learn from these mistakes and hone your investing skills over time. I hope this video has been informative and that you can apply these valuable lessons to your own investment portfolio. Don't forget to like, share and subscribe to our channel for more financial content. Until next time.